Hello traders, welcome to FreeFX. Today is the 3rd of October. This video is brought to you a couple of days late because I was meant to, usually I would have a Friday video and I did not get around to doing that because I was away. I will also do an extra video on Wednesday this week just to make up for not having done one on Friday. So apologies about that. I also don't have an image on today, but that's okay. Let's have a look at this week. It's been quite a busy week. This is the daily, and you can see that on Friday we had this price action, which is a bit messy in a way. Why is the price action messy? Well, let's talk about where we are in terms of the June lows, because the June lows happen to be around this level, and if you follow this green line that I put on there. Now the green is meant to symbolize a support or buying opportunity, hence the green. And indeed, if you look back on the 28th of September, which was a Wednesday, we had that bounce, and then the following 2 days the bounce was completely annihilated, and we sort of headed lower past that resistance, or rather support. Today we had a big candle up, so today's candle body was bigger than Friday's candle, and so it basically engulfed that candle and headed higher. The day is done, but there will be the Asian session starting in just over half an hour, so it'll be interesting to see what happens with that overnight, if anything. The motivation for today's move, I haven't looked for it. I haven't seen any big news. I don't quite exactly know what happened there for this so-called bounce, but it has moved past this June low, at least today, and closed above it. So it'll be interesting to see if tomorrow we open high and continue higher, or just start heading lower as soon as we open there. The other interesting thing for me is that on the CCI, we've seen this rising CCI in spite of 2 red days. We've had an uptick, and that obviously means that this is wanted to continue higher, just like we did back here through the start of September when we had this move higher. Another thing as well that I've just hidden there is the VIX. Our friend the VIX is capped at the moment, so it reached all the way around 33, just under actually, and then it sort of dipped, so we are just at the moment at the 30 value, which is roughly where we were when we dipped back here in the middle of June. Okay, so interestingly, at the June lows, before we had the so-called bear market rally, we're at the same level as we are now, more or less. Okay, this sort of double peak. So could this be heading lower? Well, some skeptics say no. This is just a pause until the next move higher. So we don't really know where it's going to go, so let's not speculate. But somebody asked me a question saying, well, what is your trading strategy? That was on Twitter just a few minutes ago. So I thought in this video, and I said I was going to post a video, and maybe I thought I should sort of explain it for some of you who may be joining me now for the first time. So my trading strategy is very much based on what I used to do in forex. Foreign exchange, if you know, is kind of currencies, and you pit one currency against another. So you either buy the first currency, which is quoted in the second currency. For example, euro dollar would be buying or selling euros, but they're quoted in US dollars. So you do that, on a frequent basis, because they're not really kind of investment vehicles per se, and not on a sort of retail scale. But you could buy and sell for a long time if you spot a trend early enough, or a few days or weeks into it, and it's a very long trend. So we've had a euro sell-off now for more than a year. That would have been a great trade, or a pound sell-off against dollar, again, more than a year of selling, great trade. So, but I was doing more of the sort of day trading, shall we say. Sometimes I would hold for a few days or weeks, depending, but mostly shorter term. Okay, so, but the way I started trading the SPX has been developing into something that's quite samey, with some variations, obviously, because it's discretionary. So I do have occasionally having to sort of adapt to the situation, the market conditions, like during the bear market rally, holding a short for a few weeks and then taking off the shorts one by one in the following resumption of the trend. That's one example where I deviated from my strategy. But what is my strategy? It's very simple, but I don't like the word simple because it makes it feel like it's a disservice to people who want to learn. But essentially, I try to explain it in this way. It's usually trading within the trend. So if you follow my videos, you've seen that through the years, I've usually traded both directions. So I'm a directional trader, and I trade in both directions. I don't use options to hedge or anything like that. It's just pick a direction based on ABC conditions and then use a stop loss or cut a trade if it's not working particularly well. Sometimes I have taken stop losses off in very volatile situations, knowing that once the particular event or series of events were over, I could sort of bank on that continuing in a certain direction. But generally I use a stop loss and leave it there. I have used trailed stops. Trailing stops are great sometimes, but for the scale of trades I do, they're more of a hindrance sometimes. They just get in the way and they get hit too soon when price retraces. So I tend to use fixed stop losses. Usually my reward to risk ratio is about 2 to 1, but it's not mathematically the same. I've got stats. Some months I've done 2 to 1. Sometimes, it'll be less exact than that. It might be 1.67 to 1, etc. So it does vary. And the most important thing about this strategy actually comes from the 4-hourly chart, because that's the one I use. It's great because, so the first candle is at 6 a.m. followed by a 10 a.m. and then you've got a 2 p.m. and then you've got a 6 p.m. that takes you to 10 o'clock at night. So essentially from 6 till 6. Okay, and you just got these 4 candles that describe the day. So very quickly you can see just the day in 4 candles, and that gives you a great idea of how the day went without going to the hourly. So you can get quite a lot of data in one screen, but also that there's enough detail there to kind of get you a feel for intraday price action. And so with that, I combine it. There's a combination of 4-hour candles and watching the price movement within. The other indicator is the Bollinger Bands. So I set the Bollinger Bands at the standard 2 deviations, and I have the 21 as the period. Now the moving average is set as a default as a simple moving average 20 period. Okay, 20 period. And that tends to be what I watch the most, but I actually added something, which is this blue moving average. That's a 21 weighted moving average, 21 period. And that's because it's more reactive. Therefore, when price traces its way back to the standard deviation, so the median curve, the basis as they call it. So you've got your deviation and reverts back to the mean. That's the orange line. Sometimes, in fact, during a trending period, it may not retrace all the way back there because the 20 SMA is slower to react. So for targets, the weighted moving average in blue there, as you can see, tends to be better. So if you see this bounce from the Bollinger Band back up, you're probably going to get filled at the 21 weighted moving average rather than the simple moving average there. So it's great as not to miss a target, really. Sometimes you might miss that one as well, but more often than not, I've observed that it tends to actually, if the moving average hasn't formed yet, when you look back, you find that when it has formed, prices sort of come back to it rather than the... Actually, that's a good example of a series of them. You see the price trending up. This was back in August, and you can see from the 10th of August we've got this nice little move up. Then we come down to the weighted moving average. That was 4198. The basis was at 4174. So that's a nice, neat difference, 24 points. So you could be throwing away 24 points, waiting for this to reach down to the basis, and it just goes back up. And you might say, well, why do I want to leave that trade if it goes back up? Well, because you don't know that at that point. It's difficult to know. So in that case, if you were trading short, you'd be wanting to do that down to the weighted moving average. If you're trading long, you want to basically head off that trade from the Bollinger Band here, or maybe the next candle, and let that run. Maybe if you're brave, stay on it, but it's difficult to know at that point. So you can see that it bounced off the WMA 1, 2, and almost 3 times, and then sort of went below after that, and the trend was resuming basically to the downside. I hope that's explained it enough, but essentially that's kind of why I'm using the 21 weighted moving average more and more. The third indicator, so you've got the Bollinger Bands, which again act as boundaries or filters. So if you're weighing heavily against one, you need to determine in which point you think is going to head back up across the medium area and to the high Bollinger Band, or the one on the other side, and whether when it bounces off it's going to continue lower again to the other band or stay up above the middle. And then fourth, really, we talked about the two indicators, and we talked about the Bollinger Bands. And a fourth point, which is about the Bollinger Bands, is that when the bands shrink, that means that volatility is reducing. That means the price action might be choppy and due for some kind of event where suddenly the volatility expands. When the volatility expands, you might get continuation on one side, so leaning heavily against one of the bands rather than bouncing off that one. You can see that here we're just starting to push higher and then heading straight down. The bands expand and we keep continuing to push lower. There's quite a few of these examples. Big drop, the bands expand, we continue heading lower, and then that volatility is consumed by price action and the bands shrink again. So it's a regular kind of rinse and repeat sort of process, but it doesn't make it any easier to trade when you're in the thick of it, so believe in me. The CCI is the fifth sort of element of this, and that really helps us with determining how we are moving. Now I've used the ATR, I've used the VIX, I've used lots of things, and I've showed you this because it's really quite simple, and it doesn't have all the extra kind of bells and whistles. But I can't really use them on this because I'm just using the free version of TradingView, so you can only have so many indicators. So sometimes I just head off to another chart and put indicators on that, just add them and then lose them, but just to see, occasionally keep an eye on things like I don't know, on balance volume, for example, is one I've used, and advanced decline ratio, or advanced decline line. And that gives me an idea sometimes when price continues to be choppy for a while to see what's behind price. On the platform that I use for my mobile, I have both the CCI that you see here, and what I have, which I don't have here again for restrictions on number of indicators, is the 200 period moving average, which is very important on the daily chart, because the daily chart 200 day moving average, as it would be, is currently sitting above the higher Bollinger Band. And on the weekly, we are literally just pushing on that, and today, or this week rather, we just bounced off the 200 week moving average. So the 200 period moving average on the weekly has provided support. So that's a really critical level. And as you can see here, I've put the monthly 21 weighted moving average is also an important level, because we came right up to it back in August before reverting to the main sort of downtrend. So, but I'm not showing the 200 period moving average here. I have the ATR on my mobile platform, and I use that as well. So I keep that for targets. So if the target is, the ATR is 40, my stop will be half of that, 20, and my target will be 40. Although more and more what I actually use is the Bollinger Bands. So as you can see, my current trade, my target is just under that Bollinger Band, and then the stop is halfway. So 2 to 1 pretty much. There is something else called the Keltner Channels, and they incorporate the ATR values onto the channels. And I've looked at them, but I don't have them on my mobile app, so it would be confusing to use Bollinger's on the mobile and Keltner's on the desktop trading view. So I decided to just use the ATR on the mobile app and the CCI on both of them, and Bollinger Bands on both of them. So that's all really. That's kind of how I work my way through some of these inconsistent sort of platform situations. The CCI is very important for me because it gives me a sense of extremes. So the normal CCI set as, I think it's 14, but I put it 21, and I also put in basically the levels tend to be 100 negative and then 100 positive, but I set them as 200 negative and positive. And the reason for that is that there will be too many occurrences of CCI interaction with the 100 negative or positive for me to really get a sense of how unique a situation is. So the 200 is much better as well, because if I go to the daily or the weekly, it will be much clearer that if I show the 100 is just where I'm pointing here, this line is a 100, and we've come through it many times. Whereas the 200, it acts as a filter, so you can see, since the start of the year, we've only really pushed on it once, twice, and 3 times. Okay, so when we get to those levels, we know something is going to happen, something important is going to happen. Big reversal there, middle of June, we had that. So it's important to keep that. Same on the other side, as you can see, we got to the to this level, and that sort of stalled, and then we had a divergence there, which was significant for these days, end of July till the 10th of August. So kind of 2-week divergence, and this sort of stalled, and then it was getting ready for that big drop. Now that's a difficult one to read, I grant you that. There are easier ones to read in terms of the upward boundary on CCI leading to a fall. So that's a big divergence that started and then continued for a while, and that led to a big drop there in November. But there are other examples that we could draw on, but let's kind of leave it at that extremes are easy to read as a 200 level mark, because they really are extremes, and they do tend to sometimes lead to some big price action. On the weekly, they're even more extreme, and I've shown this before, so I do look at the weekly sometimes to see positioning. So I was actually trading a bit short end of last week and a bit long and I was watching this curling up, the CCI in the weekly curling up from almost just above the minus 200, and I was thinking this is a big signal, because we had it here when it started pushing up, and that was the big bear market rally, so to speak. And so this could be a sign of something. All the indicators, you know, sort of economic indicators, the Fed on its hiking regime, and tell us that this trend, a la 2008 style, hasn't really finished, but we could have another go at getting higher before pushing lower still. Doesn't have to go all the way up to here. Remember, this is a weekly. It could come up to, you know, even just down here and then push lower. But because it's a weekly, even coming up to here will be 3762, just where I'm pointing there, and we are at 3683. So I'm just saying that 100 points might be enough to trade up, but then price might want to push lower. So there might be another final drop coming up, in which case this might diverge in a positive way and continue higher through that drop, or then revert down and push suddenly lower. And I showed you the 2008 situation where that happened. It was pretty extreme. We had it in the pandemic, the big push below the minus 200, although that came as a big sort of V bottom. So, and that's kind of how I use the CCI to watch extremes as well, and then make a decision based on that. So going back to the 4-hourly, the other thing that I've mentioned is divergence, and I've marked that in orange. So you can see the divergence here, where the CCI wasn't rising with price, and that led to this big drop on the CPI Tuesday release, 13th of September. For the previous month, we had that big surprise, and it led to that drop. So this is where price eventually, within a few days, actually conforms to the undercurrent of momentum indicators, if you like. So this unbound oscillator, which is the CCI, so a momentum indicator is an oscillator, but it can give some good signals. Here's another one that I identified. This flat sort of shelf almost. Price was dropping, and we got to the June lows, and then we started kind of flattening out. So this plateau then started curling up, and then eventually we had another dip and a move higher. This move that we had is more genuine because price and the CCI just moving in tandem, so that's a good thing to see, because it makes it much easier. Okay, so we don't need a big news story. We're moving higher, and that's the fact. We might get to, so my trade is just here under the upper Bollinger Band. We might get to there. The Asian session hasn't started yet, so hoping that I won't wake up to a lost trade, but it's nearly bedtime for me, so unfortunately that's all I've got time for today. And I will do another video on Wednesday and update you on price action here. Hope this was helpful. Thanks very much for following the channel and putting comments and liking. Really appreciate it. And I'll see you in my next video on Wednesday. Take care and happy trading out there.